The common rhetoric in the media is that property prices just can't keep going up. They're too expensive and our children will never be able to afford to get into the housing market. Is this true? Is the property party over? I'm sure you've also heard it said that baby boomers like me had it much easier back in our day since it was easier to get finance, affordability was better, meaning it was easier to get into the housing market. Well, I know that I didn't have it easy, but I did have the advantage of a number of significant property cycles and booms over the last 5 decades of being an investor. And in my early days of investing, rampant inflation pushed up the value of my properties. So back to the initial question, is the property party over? Can property values still keep rising? They're the questions I'm going to be asking my guest today, independent financial advisor Stuart Wemyss, director of Prosolution Private Clients, who spent quite some time pondering these matters. So if you're a property investor, we're just keen to find out what's ahead for our housing markets. I'm sure you'll benefit from our chat. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Hi, Stuart.
Hey, Michael. Great to be back with you again.
Thank you. I know you and your team at Prosolution Private Clients track property markets carefully, and recently you wrote a great blog. I love getting your blogs every Wednesday. I love listening to your Investopoly podcast, which I can only recommend to everyone listening to this. But in this blog, you spoke about and explained how over the past 2 decades, median house price growth over our top 5 capital cities was 5.3% per annum. However, this is considerably less than the 20-year period beforehand in 1983 to 2003, where median house prices grew 8.7%. So you compared 2 20-year periods. Clearly, Stuart, this makes a huge difference to investors by increasing the value of their properties.
I was really surprised by the numbers. I assume you were too,
Yeah.
Michael, and it never really sort of dawned on me. I mean, I was talking about this with someone just a little while ago. My intellectual curiosity, I guess, gets the better of me sometimes, where I start to think about these things perhaps sometimes too deeply, and I start to look at some numbers, and that's where a lot of my ideas around blogs and so forth come from.
Yeah.
And the stimulus is really conversations with clients as well. And I think this sort of analysis helps us put together better advice for our clients, hopefully, as well. But, I just stumbled upon this data in terms of just looking at it in decade and multi-decade periods. And it was really surprising. And of course, the first thing that I had to think about was what's contributed to this differential over the past 20 years, and will it persist?
Well, interestingly, it's important to get this evidence-based decision-making. There's too many people out there talking about a 7-year property cycle. Others are talking about an 18-year property cycle. They're using maybe some old-fashioned, outdated concepts or concepts that never really happened, but they believe they're true and they're making their decisions based on that, which can only lead to underperformance or, at worst, loss of money. So one of the things I noticed, and I said in my preamble, was that when I first started off, and it was purely coincidence, I just bought my first property in the early 70s and Gough Whitlam came into power and inflation came up, and there wasn't the daily, the weekly, even the monthly figures of what was happening to property values. You had to wait some time before you got economic data. All I know is that the value of my property kept going up and allowing me to borrow against it and buy my second one within a couple of years. How much did inflation affect the early days that you were talking about in the 1980s and 1990s?
Yeah, okay. So, I mean, you quoted the figures, the 2 decades, the most recent 20-year period and the 20-year period before that being 5.3 versus 8.7. So it's a 3.3 differential in growth rates that we're talking about. However, in Melbourne and Sydney, it's more stark. It's sort of 5 versus 10%, so it's a 5% differential between, the most recent 20-year period and the previous 20-year period. So inflation in that previous 20-year period, 83 to 03, was 4.1%, And in the most recent 20-year period, 2.7%. So 1.3% is inflation. That's an easy one to point to. So on a average five capital city basis, we're talking about a 2% differential net of inflation and about 3.5% difference in Melbourne and Sydney. And I think when I say point out Melbourne and Sydney, the reason I do that is because most investors would be in Melbourne and Sydney. Just from a population perspective, of course, most of the population of Australia is in Melbourne and Sydney. And so that's the most relevant, and it's the most stark. You've got half the level of capital growth, which is substantial from a future price point perspective. And so at least inflation explains some of it.
Well, we're talking about a 1 or 2%, 3% difference in growth, but compounding over that 10 or 20-year period, that makes a huge difference to the value of your property, the increasing in your rents, and the ability to borrow against your increasing equity to buy further properties, Stuart.
Yeah, if you look at those five capital city averages, we're talking about in the first 20 years, so that between 83 and 03, your property would have been worth 5 times what it was at the beginning, whereas the most recent 20-year period is less than 3 times. So it is a substantial, that compounding difference, albeit only 3.3%, but it does make for a very large difference. And as a property investor, I want to know, is 5% the new normal? Like, is that what I should expect? And in fact, between 83 and 03 was just an aberration, or in fact, will it turn around? That's the sort of question I sort of put to myself after seeing that data.
Well, we often hear the story that property values or the value of good properties doubles every 7 to 10 years. Well, that's not the case if you're getting 5.3% growth, is it?
No, you need 7.2% compounding growth on average for your property to double in value every 10 years. So you're well below that. I think 5%, you're probably close to doubling every 15 years or something in that order. So still okay. I mean, it's not terrible, but does it justify the risk and reward return? I don't know. Now, hopefully these are just averages, of course, median values. So hopefully if you apply a rules-based approach to investing, you can outperform the median. And I think all property investors should be aiming to do that. I think it's important just to remind ourselves this data is just the average, which is a whole bunch of great properties and a whole bunch of very terrible ones as well, and some average ones in the middle.
Well, a moment ago you talked about inflation being one of the factors that affected the increased growth of properties in that first 20-year period. What else accounted for the difference in the second 20-year period when we had significantly lower growth?
I think our minds are pretty fresh in regards to the pandemic that we just experienced. And, we're still wearing some of the hangovers of that pandemic in terms of higher than normal interest rates. And of course, in that previous 20-year period, you had things like global financial crisis and so forth, which I think is more fundamental to property because it really impacted banking, financial services, borrowing capacity, lending rules. You've had the Royal Commission with a tightening in lending rules as well in the last 20 years. But the previous 20-year period, 83 to 03, wasn't without its changes as well. You had floating of the Australian dollar in 83, capital gains tax introduced in 85. You would think that's a pretty significant impact to property investors. The stock market fell by 45% in 1987, if you're old enough to
I
remember
that well. I actually remember where I was when I heard that. We were on holidays in Sydney with a friend whose name is Michael and his wife. I wasn't invested in shares at that time, but I saw how he got a kick in the stomach when he heard what was happening to his share price. And I thought, all that global financial crisis, that's just problems overseas. That's not going to affect us here. Boy, I was wrong.
Yeah. And finally, GST. GST was introduced in 2000. So there was a lot of changes in that previous 20-year period as well. I guess as investors, we've got to expect similar shocks in the next 20 years. We don't know what they're going to be, but there's going to be naturally some shocks. So I don't really think we can point to any major shocks that are necessarily shaping the data over those 2-decade periods?
Well, I often say we should plan for our plans not to go to plan. Every year there's an X factor, and every decade or so the world breaks, whether it was COVID, GFC, other crises. So you're right, you've got to have contingencies for that. And I know with your background as an accountant and a financial planner, you make sure that your clients are protected in all sorts of ways. I think one of the other big changes over the last couple of decades has been the decrease in borrowing capacity, in particular maybe over the last decade, with it being harder to get money at the same sort of multiples of your income.
Yeah, so if you look at that decade, 83 to 03, there was a lot of changes in borrowing capacity. But borrowers at the beginning of the 80s were borrowing somewhere between sort of 2.5-ish times their family income. And remember, the family income in the early 80s, late 70s, early 80s, tend to be one person working, one person at home. So it was a single income family. And they were only borrowing sort of 2.5 times that family income. Before the GFC hit, and this is before obviously tightening in borrowing rules, all those sorts of things. And I appreciate it's slightly outside of that band, that first 20-year band, because we're talking about 07. But around that time, and I started my business in 02, which is perfectly in that band, it wouldn't be unusual to see people successfully borrowing around 10 times their family income. So that's almost 4 to 5 times more than what people were borrowing at the beginning of the 80s. Notwithstanding that by the time we got into the 2000s, many households had dual incomes, had 2 incomes. So that's a substantial amount of additional monies that flowed into the property market over that 2-decade period. Now, that continued until about 07, 08, 09, sort of around that level. And then
things got a little bit silly at the end. There were no doc loans, low doc loans, and there was even for a short period of time loans where you could borrow on future potential capital growth. Really lucky that the global financial crisis stopped all that. Otherwise, we could have had a similar meltdown to America, which had written a lot of very bad loans.
I remember one lender, Michael, had a product that allowed you to borrow 105% of a property. So really almost no money down, because you could borrow the stamp duty and so forth. So yeah, it did get really silly. And 10 times family income as a general rule is way too high. And it was way too high back then. It's still way too high today. But we had tightening in lending standards, and now the average is around 6.5 times income. So we started at sort of 2.5, went to, at the max, not everyone went to 10, but at the max it went to 10, and now it's down closer to sort of 6.5. APRA define a risky borrower as anything above 6. And I think that's really where the appetite is today for most lenders. If you're borrowing more than 6 times income, or you want to borrow more than 6 times income, that's going to be a challenge. Somewhere between 4 and 6 is pretty comfortable. So we've had a big change in borrowing capacity in that 20-year period. And I do know, and I've charted it before, that money flows, that is loan volumes and so forth, have a direct correlation with capital growth. So when obviously money flow is a lot lower, capital growth is a lot lower, and the reverse is true. So borrowing capacity, so based on that data, borrowing capacity's probably had a pretty big impact in those 2 20-year periods, and it contributed to lower growth in the most recent 20-year period.
Well, looking forward then over the next 10, 20 years, clearly there are several positive factors for our housing markets. The strong immigration that we're getting, the low supply of properties, the undersupply that we can't catch up for quite a number of years, a strong economy in general, and a sound banking system. I guess the Reserve Bank's going to try and keep inflation lower, so we're not going to have the very high inflation that we had between 1983 and 2003. So inflation is going to be lower, and I guess borrowing capacity probably isn't going to change a lot. So what do you see happening moving forward?
I think that's right, Michael. I think we can't rely on increasing borrowing capacity to push property prices higher. And actually, if we think about it just from a economic perspective, I also don't think, Melbourne and Sydney grew at 10% compounding on average for a 20-year period. That's also unsustainable, and we're talking about median house prices here, of course, but that's unsustainable. We'd have a housing affordability problem if we don't already. We'd certainly have one if they continued. So I think probably 5%, or at least my starting assumption as an investor is that 5% is probably the base level. That's probably what we should anticipate median house prices to do over the next 20 years. The question is, how do we, as property investors, how do we generate higher growth than that? So, the general aim would be to invest in a property that doubles in value every 10 years, which means we need 7.2% compounding growth on average. So if the median's getting 5, how do we get 7? Well, the first thing is that we want to apply, as we've spoken about many times in this podcast, we want to apply a set of principles to select a property that is investment grade, something that's got the attributes, strong land value component, scarcity, all those sorts of things that are going to make it a great property. As I should remind you, we're talking about median data here, which is just a huge set of data, including a lot of very terrible assets from an investment perspective, a lot of average ones and a lot of good ones as well. But it really is the midpoint of all that whole data set. So it shouldn't be too difficult to outperform the median using that set of principles.
Now, that makes sense, Stuart. And really the concept is that we should be outperforming the averages because you don't want to get the result average property investor gets. So the party isn't over. Will it be more difficult? Will there be issues, challenges, roadblocks ahead? Of course there are. But I think one of the things that both you and your clients at Prosolution Private Clients and us at Metropole believe in is you've actually got a plan. It all starts by putting a strategic plan together and then, I guess, planning for your plan not to go to plan and having backup situations. But that suggests having the right plan, having the right ownership structures, having the right insurances and the right finance with buffers to see you through the ups and downs. Any other final advice for people to get through the next decade or two?
Yeah, I think it's really important. I mean, in a rising tide, all ships rise, right? So if we were an investor in the early 80s or mid 80s and the median's going up by 10% compounding over a 20-year period, you could have almost bought any property and done well during that period. And that's kind of true if we sort of think back to different properties around and sales that we come across. And so I think it's really important for property investors to be more proactive today than it was necessary back in the 80s. So if we're assuming that the average or the median house price growth, let's call it average growth, is going to be lower in the next period of time, not only do we want to implement a strategy to buy a good asset opposed to from an average asset, I think we need to be proactive in trying to find additional value opportunities as well. And I think there's two things that investors can do or think about doing. The first one is being more conscious of property cycles. So be more conscious of what part of the cycle are you buying into, knowing that when we look over history, it's pretty obvious that property moves in two distinct cycles. Most geographical markets do. There tends to be a growth cycle that might last 5 to 7, 10 years around about that time that tends to deliver above average growth, 7, 8, 9, 10% compounding growth on average over that time period. And that growth cycle is typically followed by a flat cycle, also 5 to 10 years, but you're going to get very little growth, maybe less growth than inflation. So what you don't want to do is buy into a market just before a flat cycle, or if I put it a different way, just at the end of a growth cycle. Now, that's difficult to do because you go, well, look, Brisbane's done 10% over the last 5 years. Let's go and buy in Brisbane because obviously it's running. And that might be a good decision. I'm not dissuading people from buying into Brisbane, but if you look at Melbourne's underperformed over the last 5 years substantially compared to all the other capital cities. So maybe the better decision is let's go and buy Melbourne because the last 5 years has been poor. It might be continue to be poor for the next couple of years, but we know then it's about to enter into another growth cycle. So I think being very considerate of where markets are in their cycles, I think is a good thing to do anytime. But I think more important if we all assume that we're no longer in a rising tide, that in that 2083 to 03, it was a rising tide, great. But in the last 20 years, that tide hasn't been there. and we can't necessarily rely on it in the future.
Well, when we had a chat last month, we talked about why we both believe the Melbourne property market's undervalued. And again, we're not trying to say time the cycle, but if you can get the free kick at the beginning of a sudden capital growth or faster capital growth, that would be good. And I don't think either of us are suggesting Melbourne is going to be the strongest performing market this year or next year. But that just keeps going back to what we've always said. Investors should have at least a 10-year time frame. And in my mind, that's short term. Long term is really talking 20, 30 years when most people that we see aren't going to retire till then. And then they're going to live another 30 years and then they're going to want to leave their assets to their children. So you've really got to think multi-decades as an investor, not what's going to happen in the next 6 months to interest rates or government decisions.
There's another thing you can do as well, Michael, just to add to that, apart from, or in addition to, I should say, thinking about where market cycles are at, and something that you've spoken about for many years / decades, which is manufacturing equity. So that is improving the value of the property. Now, to my mind, you could do that in a couple of different ways, but to my mind, it would be good to buy a property that has multiple alternate uses, or at least one additional alternate use, I should say. So, for example, I might go and buy a house that's mostly land value. It has a dwelling on there. It's in tenable condition, but it's not so great. In a great location in terms of suburb, quiet street. Now, when we look at the street, most of the houses have been demolished and rebuilt. Most of the houses are much larger family homes. These days, compared to, say, 60 years ago, for instance, we're going to build a much bigger home.
A gentrifying area.
A gentrifying area. So I can go and buy that asset, and maybe my plan is to actually do nothing other than just regular maintenance. I realise I'll take a little bit of a haircut on the yield because the property's not so flash. But I spent most of my money on land value, and hopefully in a rising tide, land values increase, the asset selection's been good, it'll do its work. If it doesn't, if the market doesn't do its work, well, maybe one day I can demolish it and build a family home and then go and sell it to someone that's looking to get into that area that doesn't need to go through the hassle of approving and building and mucking around with it. And that'll enhance, because naturally that will enhance the value of that asset by doing that. So that sort of description is really a strategy that you can implement that if the market doesn't deliver the passive results, you can be a little bit more active about it. And I think it's wise for property investors to start thinking about this and kind of, as you keep saying, almost plan for the worst, hope for the best. You hope that the market does its thing, but if it doesn't, at least you can implement something else with that property. It has scope to add value.
Well, I like the opportunity to add value, especially since we're not going to get carried away with double-digit growth over the next decade. There will be periods where certain markets will do that, just like they have in the last year, just like they did in 2020-21. But let's not count on it. And if you get that, that'll be a bonus. We'll be explaining each month when we get together about how to take advantage of the markets. But in the meantime, if people want to get more of your information, I'm going to leave some links in the show notes to your great Investopoly blog every Wednesday, and also your Investopoly podcast. And if people want to understand a bit more about what you and your team at Prosolution Private Clients do, well, I'll leave a link to that. But maybe you can quickly tell us.
Yeah, we're a holistic firm, Michael, that works with clients holistically, which means we provide tax advice, financial advice, and we're asset class agnostic, which means that both financial advice in respect to property and shares and super and so forth, and of course, mortgage broking. And the best analogy, Michael, that I like to use is, we can go out to a builder and ask them to build a 3-bedroom home, for example, and they will construct a perfectly satisfactory property. It'll have 3 bedrooms, a kitchen, a bathroom, etc. Or alternatively, the best analogy is, well, I'll go to an architect and they will build something that is specific to me, that meets my goals, that suits my family and so forth. And wealth is at the center of everything we do. So we develop a strategy for a client and then everything is built around that strategy. So if we have a tax planning conversation, it's really in relation or provides context for that discussion. And that holistic approach, I think, gives us the best opportunity to add value.
Well, thank you. I look forward to our chat again next month. And as I said, I'll leave a link in the show notes for people who want to find out a bit more about what you do. Catch up with you soon.
Thanks, Michael. Cheers.
I enjoy my regular monthly chats with Stuart Wemyss, who brings great advice, evidence and factual-based advice to our housing markets. If you don't currently subscribe to this show, why not stop for a sec and on whatever podcast player you're watching this or on YouTube, just click the subscribe or follow button so twice a week you get information from my guests and me. I guess the other thing you would have gleaned from our discussion is that over the long term, our housing markets are going to keep performing strongly. We're at the beginning, still the early stage of a new upturn stage of the cycle, which started in early 2023. But there's no doubt that all the economic, political and financial challenges the world's throwing at us is worrying many would-be home buyers and property investors. But how long are you prepared to wait? Because strategic investors aren't worried about where interest rates or the economy is going to be in 3 or 6 months' time. They're encouraged by where the property markets will be in 5 or 10 years' time. So are you interested in getting involved in property, maybe as an investment or a new home, before FOMO drives the herd back into the market when eventually interest rates start falling and all the news is positive? If you are, why not have a chat with one of the wealth strategists at Metropole? It's obligation-free, and we're much more than buyer's agents. By the way, we've got no properties for sale, but we help our clients safely create intergenerational wealth through strategic property and wealth advice. And while we're big enough to tip the scales in your favour, we're small enough to care. So go to metropole.com.au, there's a link in the show notes, and organise an obligation-free chat with one of the wealth strategists at Metropole to discuss your options.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to ask you a question that should help establish your focus. The question is, if everything stays the same, what one change would create the most impact? If you think about it, in every arena of your life, from your career to your health to your relationships to your investing, there are countless variables that govern your progress and your growth. And when faced with a variety of potential variables, the decision of where to focus your attention, where to focus your energy, sometimes becomes challenging. If you don't focus, you end up scattered, applying modest attention to a bunch of things rather than intense attention at one thing. By adding a forced constraint, something I'm saying, one change, well, you can actually create great clarity. In every given arena, if everything were to stay the same as it is today, what one change could you make that would create the greatest positive impact in your life? Okay, here's an example in my life. Let's say my goal within my health arena is to lose weight, to become healthier, become fitter. I ask myself this question: if everything were to stay the same, what one change can I make in my health routine that will create the greatest positive impact towards my goal of being healthier and losing weight? If I look at all the variables about that, it's actually pretty easy. I can say with confidence that if I focus my attention on my diet and, in fact, just cutting out chocolate, it's going to create the greatest positive impact. It's the one area where I don't feel I've applied my full attention, I cheat, and the results show. But if I commit to 90 days of intense attention and energy towards that single variable, just cutting out chocolate, not buying it, not having it in the house, everything else will stay the same. But the idea here is that I'm going to be a much better person for it by looking after the one important thing. So asking yourself this, asking that question, forces you to identify the atomic variable. The question you should ask yourself again is, if everything else stays the same, what one change would create the most impact? Everything else is a distraction. Focus there first. Progress follows attention and action. Do less and create more while you're doing it. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?